For years, there's been one idea that keeps resurfacing whenever tensions rise between Washington and Beijing. A single question that sounds simple, almost obvious. What happens if China decides to pull the plug? China sits on an enormous pile of US dollar assets. Treasuries, bonds, reserves, securities tied to American mortgages, even ownership stakes in US companies. More dollar exposure than any country on earth. More than Japan. More than the UK. More than the entire European Union combined. And that fact has fueled a powerful fear. If China ever dumped those dollars, the story goes, the US financial system would unravel overnight. Interest rates would explode. The dollar would collapse. America's ability to finance itself would vanish. Global markets would panic. It's been described as the ultimate financial weapon, the doomsday switch, the nuclear option. But here's the part almost nobody talks about. China can't use it. Not because they don't want to. Because the moment they try, they trigger their own collapse. Those trillions aren't a weapon aimed at the United States. They're a trap that China is standing inside. And the more you understand how that trap works, the clearer it becomes that both sides are locked into the same structure, unable to escape without catastrophic damage. This isn't a standoff where one side wins and the other loses. It's a situation where pulling the trigger destroys both. And the truly dangerous part isn't some dramatic future attack. It's the slow, quiet stress building inside the system right now. As of mid-2025, China officially holds roughly $700 billion in US Treasury securities. That number alone surprises people, because it's far lower than it used to be. A decade ago, China held well over $1 trillion. Today, it's the lowest level since the aftermath of the 2008 crisis. In just one recent month, China reduced its treasury holdings by over $25 billion. That wasn't random, it wasn't accidental, and it pushed China out of second place among foreign holders of US government debt. But focusing only on treasuries misses the real picture. Because treasuries are just one layer of China's dollar exposure. Chinese institutions also hold hundreds of billions in US corporate bonds. Debt issued by American tech firms, banks, and industrial giants. They hold vast sums of plain dollar reserves, sitting as cash equivalents. They own mortgage-backed securities issued by US housing agencies, instruments deeply embedded in the American financial system. And through state-linked funds and enterprises, they hold massive equity exposure to US companies. When you add everything together, the total dollar exposure doesn't land at one neat number. It falls in a range. Somewhere between roughly $3 trillion and $3.5 trillion. The often quoted figure of $3.2 trillion isn't exact. It's a midpoint, a consensus estimate that captures the scale of the problem. And scale matters here. Because this isn't money sitting in a vault that China can simply walk away from. These dollars are woven into the structure of their entire economic model. To understand why, you have to go back decades. For nearly 40 years, China ran the largest sustained trade surplus in modern history. They sold manufactured goods to the world at an unprecedented scale. Electronics, machinery, clothing, furniture, consumer goods of every kind. And the world paid for those goods primarily in one currency, US dollars. Chinese exporters earned dollars. Those dollars were converted into yuan through the banking system, and the dollars themselves flowed into the People's Bank of China. Year after year, the pile grew larger. But holding cash wasn't an option. Cash loses value over time, so China invested those dollars. US government bonds were the obvious destination. Deep market, high liquidity, global trust, backed by the world's largest economy. But buying treasuries also served another critical purpose. It helped keep China's currency weak. Every time China recycled dollars into US assets, they reinforced demand for the dollar and limited upward pressure on the yuan. A cheaper yuan made Chinese exports more competitive. That boosted sales, which brought in more dollars, which were reinvested again. It was a self-reinforcing loop. China's rise as the world's manufacturing hub was inseparable from this mechanism. The dollars weren't incidental. They were the accumulated output of an entire development strategy. That's the first layer of the trap. Now imagine the scenario people love to speculate about. China decides they've had enough. They order a massive sell-off. Hundreds of billions in treasuries hit the market. Dollar reserves are converted. Markets panic. Bond prices plunge. Yields spike. Mortgage rates soar. Housing freezes. Corporate borrowing collapses. Banks face balance sheet stress. The Federal Reserve steps in, printing money to stabilize markets. Inflation surges. The dollar weakens globally. It's a nightmare for the United States. But it's even worse for China. Because the moment China triggers that sell-off, the dollar doesn't just fall for the assets they sold. It falls for the assets they still hold. If the dollar loses even 30% of its value, China instantly absorbs losses on trillions of remaining dollar-denominated holdings. Hundreds of billions wiped out in weeks. A massive hit to the reserves backing their financial system. That alone would be destabilizing. But it doesn't stop there. China's economy still depends heavily on exports, and the United States remains one of its largest customers. If the U.S. economy enters crisis, American demand for Chinese goods collapses. Factories lose orders. Employment falls. Growth slows sharply. At the same time, a falling dollar means a rising yuan. Chinese exports become dramatically more expensive overnight. Even if buyers wanted to keep purchasing, many couldn't afford to. Then there's the debt problem. Chinese companies and banks have borrowed extensively in dollars over the years. Dollar funding has historically been cheaper, but those debts don't disappear when currencies move. When the yuan strengthens sharply against the dollar, the real burden of dollar debt explodes. Companies earning revenue in yuan suddenly owe far more in real terms. Refinancing becomes impossible. Defaults rise. Banks absorb losses. The state steps in. But the state's balance sheet has already been hit by reserve losses. To stabilize the system, authorities would have to inject liquidity, expanding the money supply. Inflation resets. Household purchasing power erodes. Social pressure builds. And energy makes everything worse. China imports a large share of its energy. Oil and gas are globally priced in dollars. Currency disruption translates directly into higher domestic energy costs. Manufacturing margins compress. Inflation accelerates further. This is why the so-called nuclear option isn't an option at all. Using it would detonate inside China first. Which brings us to the uncomfortable reality. China isn't holding the dollars because they want to. They're holding them because they can't let go. So instead of dramatic action, they've chosen a different path. Slow, deliberate escape. They've been reducing Treasury holdings gradually. They've been accumulating gold. They've been building parallel payment systems to reduce reliance on dollar-based infrastructure. They've been signing bilateral trade agreements that allow settlement in local currencies. And they've been trying to rebalance their economy toward domestic consumption. None of this happens quickly. Global trade doesn't switch currencies overnight. Markets choose convenience, liquidity, and trust. The dollar still dominates on all three. Even now, only a small fraction of global trade is settled in China's currency. It's growing, but from a very low base. At the current pace, meaningful displacement takes decades. That's the problem. Because China doesn't have decades of margin. The US, meanwhile, is accumulating debt at an accelerating pace. Interest costs are rising. Deficits are persistent. Confidence in long-term fiscal discipline is eroding. The dollar's share of global reserves has been falling steadily for years. Not because China is attacking it, but because the system itself is under strain. This creates a race. China needs time to diversify without triggering collapse. The dollar-centric system is weakening faster than that timeline allows. Neither side can move aggressively without triggering the very crisis they're trying to avoid. So both proceed cautiously, quietly, incrementally. And that's why this situation acts less like a weapon and more like a deterrent. China's holdings constrain U.S. policy. The U.S. can fully weaponize the financial system against China without risking retaliation that destabilizes its own economy. China can't liquidate without destroying itself. Each side limits the other. It's a financial standoff built on mutual vulnerability. For decades, this arrangement benefited both. Cheap goods for the U.S., rapid industrialization for China, low interest rates, high growth, rising corporate profits. But the conditions that made it work are fading. Costs are rising. Debt is mounting. Growth is slowing. And the structure that once delivered prosperity is becoming unstable. The outcome isn't predetermined, but none of the paths forward are painless. There's a chance of gradual transition to a more multipolar monetary system. There's a risk of crisis triggered by shock or miscalculation. And there's the possibility that internal weaknesses bring the system down before anyone escapes. What's certain is that this isn't about a dramatic button China can press. It's about a slow, structural unwind that affects everyone holding assets denominated in currencies tied to this system. Understanding that changes how you see global finance. Because the real danger isn't what China might do. It's what happens if the trap breaks on its own. And when it does, the effects won't respect borders, flags, or narratives. They'll show up in prices, savings, investments, and living standards worldwide. That's why this story matters. Not as a geopolitical rivalry, but as a structural fault line running through the global economy. And it's why watching how China quietly reallocates capital, what assets they prioritize, and how they hedge against currency risk offers one of the clearest windows into where the system is headed. Because when the people most exposed are trying to slowly step away, it tells you everything about how fragile the ground beneath them really is. If you want to understand where global finance is going next, this is the pressure point to watch. At Finance Matters, we explore history, economics, and perspective without hype or speculation. If this video added value, subscribe to the channel and press the bell icon to receive future educational releases. Your support helps keep this content independent and informative.